Hello and welcome to MF Corner. I'm Sonal Bhutra in the Mumbai studio, and today we are going to talk about bank deposits moving to mutual funds. At a time when banks are scrambling to get deposits, people are parking money in mutual funds. Equity AUM has surged from 26 lakh crore rupees to 41 lakh crore rupees. We've seen bank deposits or mutual fund AUM as a percentage of bank deposits also grow to around 31% in August 2024. What explains the inflows? Is it the new investors or is it largely the move from bank deposits? To talk more in detail, we have with us Nilesh Shah, Managing Director at Kotak Mahindra Asset Management, joining in now. And a little later, we'll discuss duration funds with Devang Shah, the head of fixed income at Axis Mutual Funds. Nilesh, good afternoon. Thank you so much for joining in today. And this has been a long-going debate and discussion as well, because we've been talking about bank deposits moving to mutual funds. Is this largely money moving, or is it new investors also coming in and contributing to fund flows? Because even bank deposit number is growing. What explains the phenomenon, and how do you see this panning out going forward?
So Sonal, thank you for giving me an opportunity to explain mutual fund industry viewpoint. Number one, mutual fund don't accept cash as subscription, neither pay cash as redemption. If you, Sonal, give me check, let's say it came from a State Bank of India, you invest in Kotak Mutual Fund, I will deposit it in Kotak Mahindra Bank. And if I purchase equity on your behalf in my fund, I'll give the check for some other bank. Effectively, money remains within the banking system. It doesn't go out. So bank deposit can never move to mutual fund because mutual funds are also part of the bank deposits. Are we getting flows from new investors? Undoubtedly, yes. We should be crossing 5 crore unique investors very soon. So undoubtedly, new investors are coming. But as they allocate money, it's not impacting bank deposits. Our money remains within the banking system only.
That because largely the idea is that most of it is moving. People are not going with savings bank account right now. They think going and getting an SIP is a better way, of course, for returns. So while we talk about that big SIP flow, Nilesh, at record high again in August, data also indicates that 57% of this SIP got discontinued as a percentage of registered SIP. What explains that? Is it worrisome, or we should just look at the headline numbers?
So Sonal, as our size keeps on growing, we expect people to redeem. There will be people who would have invested for travel. There would be people who would have invested for their daughter's education. There will be people who would have invested for their son's wedding. And there are people who are retiring also. Now, mutual fund AUM, as you know, in equity market has gone up to about 41 lakh crore. Collectively, it is about 66 lakh crore. It's fair to assume that some money will be redeemed. That redemption on a base of 66 lakh crore is reducing SIP number. It's a miracle that SIP numbers still remain positive despite people redeeming on such a large base of 66 lakh crore.
Okay, I just to follow up on that. So because people worried or investors worried that maybe this is happening because markets are at a high that we are seeing right now. So according to you, this redemption is quite normal and this is nothing to worry about.
As my base goes up, redemption number will keep on going up and there's nothing to worry about it. In fact, we have been advocating investors, if you're overweight in equity at this point of time, if you are leveraged into mutual fund investments, if you are overweight in small and mid cap stocks, which have really run up, this is time to do profit booking and go to neutral allocation to equity as an asset class. So the tactical asset allocation we also recommend to our investors, and which is why if some redemption comes, it's perfectly normal.
Okay, all right, take that point. Now the next part is how equity AUM has grown. It has grown from 26 lakh crore to 41 lakh crore. That's a 55% growth that we have seen. While fixed income has seen a growth of 18% to 17.8 lakh crore. This is over a year that I'm talking about. Why do you think debt is still not considered as the attractive investment option to diversify?
So one, in the mutual fund debt side, now there is no taxation advantage like it is there in NPS or insurance. We are at par with any other, bonds, debentures, deposits kind of instrument. Second, investors' allocation towards fixed income has been high by virtue of investment in other assets like deposits, bonds, debentures, company deposits, and so on and so forth. So to mutual fund, they are looking at, oh, what gives me better return? And hence they are probably investing in equity far more than they are investing in debt. I hope and pray that investors are doing appropriate balancing of their portfolio and they are following the dharma of asset allocation. We'll be very happy to welcome you in our debt funds. But if not, please ensure that there is suitable allocation to debt in your portfolio, especially for meeting your short-term needs.
And talking about asset allocation, I'll discuss that with you towards the later part of this conversation as well, because that continues to remain the thumb rule, right? You know, the other phenomenon that we've seen in the industry now, and this also has been spoken about a lot, Nilesh, is a lot of money is coming via NFOs and thematic funds in the last few months. While we talk about the frenzy in IPO markets, should similar caution not be advised for more NFOs coming up?
So undoubtedly, there are newer players emerging and they will have to launch NFOs. I can't launch a large cap fund because I've already filled that category 25 years back. But a new AMC will have to launch a large cap fund. So there are new NFOs coming from newer AMCs as they fill their product basket. In our case, we are launching thematic funds, sectoral funds. Again, there are certain times where you want to launch a thematic fund. For example, we are in the process of launching MNC fund because we think at this point of time, it makes sense from a valuation point of view and from growth point of view. All of us are trying to fill the product basket. But the fact is that if I am launching NFO, it does not mean that you should invest into it because it's available at 10 rupee or it's an NFO with certain closure date. All these funds will be available to you at a later date also, as these are open-ended funds. Please consult your financial advisor and then take a call. You don't rush into NFO unless it meets your investment goal.
That's a sane advice. While it does give a lot of options or product diversification to asset management companies, it does give a lot of options to investors as well. And sometimes that can get confusing, right? And that's why at this point in time, if we get an advice like this, that you have to do it according to your allocation, your risk, and if it suits your goals, only go for NFOs. Because even sectoral funds, some of them at high valuations saw NFOs come by, right? So, Nilesh, we come down to the same point. At this point in time, if someone has to start their mutual fund investments with Nifty at 26,000, market at record highs, gold at record highs, how do you suggest they go about it? Pure equity funds, multi-assets, what should the ideal mix be? Because you said now is the time to maybe redeem as well.
So if you are investing with 5-year plus horizon, then only invest in equity fund. If you are investing with the expectation that the return which you get in last 1 year, your last 4.5 years is going to be repeated in next 1 year, your next 4.5 years, please don't invest in equity. You will have to invest with longer term time horizon and you will have to invest with moderate return expectation. As Sonal mentioned, Nifty is at all-time high. The base has been re-rated significantly and hence from here onwards, earnings growth will deliver return, not the PE re-rating. Second, for your physical health, you go to a doctor. You don't go to a chemist and ask for medicine. You consult a doctor and then demand medicine from the chemist. Same way, for your financial health, please take services of a recognized advisor or distributor who can tailor-make portfolio to meet your risk profile and investment objective. And thereafter, you choose what is appropriate for you. We remain bullish on equity, but on a longer term basis and with moderated return expectation. We remain bullish on duration. This is time to go and buy the longest possible maturity in fixed income. And we remain bullish on gold also because central banks all over the world are becoming like Indian housewives. So today you have opportunity to invest in all the three asset classes, but please follow the dharma of asset allocation.
That totally makes sense. The issue with this market is everyone is a chemist and everyone's a doctor themselves, Nilesh. And that's the reason why so many questions come up when Nifty hits those record high levels, right? And that's why we have questions for you on this. Nilesh, I have to ask you about the share of passive AUM that we are seeing. That has also doubled from 8% to around 16% in August now. Passive AUM is at an all-time high in August 2024. Investors are still warming up to passive style of investing. Is it very straightforward or requires more evaluation? Because usually it's considered the easy way out, and that's why more focus is on active funds.
So Sonal, in the passive space, there is fair amount of commodity space which is not there in active, like gold fund, silver fund, and so on and so forth. Then there are certain overseas fund like Nasdaq ETF, S&P 500 ETF, and so on and so forth. Again, very few of us have the capability to manage overseas exposure, and we generally launch index or ETF fund around the same. Third, a very large portion running into few lakhs of crore is coming from employees provident fund organization. They rightfully have taken a call that with our kind of long-term horizon, it makes sense to go into passive fund with lower expenses rather than active funds. Now they are losing the opportunity to generate alpha through investment in active fund, but the kind of situation they are in and being a provident fund, pension fund organization, I think their strategy is appropriate one. There are also certain registered investment advisors which are recommending passive funds to their clients, looking at the themes and the sectors and the factors which these passive funds are doing. My recommendation to investors, you should invest in active fund only when we deliver better return than benchmark index, else low cost passive fund is more appropriate for you.
Okay, take that point. Always a pleasure speaking with you, Nilesh, and thank you so much for joining us today. Specifically on MF Corner, we do hear your market insights otherwise, but it's a pleasure to have you specifically on MF Corner today with all those expert comments. Thank you so much for joining in. Okay, all right. On that note, we'll take a quick break. On the other side, we discuss duration funds with Devang Shah of Axis Mutual Fund. All that and a lot more. Stay tuned for that. Welcome back. You're still tuned into MF Corner, and it's time to talk about duration funds. Let's welcome Devang Shah, Head of Fixed Income at Axis Mutual Fund, to talk all about that. Devang, thank you so much for joining in today. It's a pleasure speaking with you. And while we have spoken a lot about the Fed rate cut that has come by and how it would impact the debt markets or fixed income markets in general, let's talk about its impact on duration mutual funds. But first up, just to try and understand what these funds are, what are the types of duration mutual funds, and what are the kinds where one should look at in investing right now?
So thanks, Sonal. I'm sure we all understand that SEBI has done a very good job of classifying all the open-ended debt funds into various categories. And they have done it on the basis of duration as well as credit. And we have today a category from overnight fund where you can invest for 1 day to a long duration fund where probably if you have a larger investment horizon or very long investment horizon of 5, 10, 15, 20 years, you can invest in such categories. Specifically, when you spoke about duration categories, we have short-term duration categories, medium-term duration categories, and long duration categories. All of these, according to the mandate of the fund, invest in shorter duration funds are generally up to 1 to 3 year duration. Medium-term to long-term duration categories are into 3 to 7 year duration buckets. And long duration categories are actually funds where are you investing more than 7 years duration categories. In the current macro environment, I think the long duration funds make a lot of sense for investors, and I'll try and give you some more color why at this point of time long duration funds make a lot of sense.
Okay, so exactly that was going to be my next question, Devang. How can duration funds be a strategic bet for investors now? How does it connect with the rate cycle we are in?
Yeah, so you started the topic with Fed rate cuts, and I'm sure Fed started with the 50 basis cut. Now there's a lot of chatter about where the RBI will follow the suit, and we start seeing RBI easing. It's not only Fed. You actually look across at the last quarter, you have had multiple central banks cutting rates. You look at Bank of England, you look at ECB, Swiss Central Bank, Bank of Indonesia, Chinese Central Bank. So you've seen a lot of central bank cutting rates. So that gives a lot of breathing space to RBI to focus on what's happening on the local macros. If you look at the local macros today, I think we are at the pink of the hill where you and specifically from a bond market perspective, I think the local macros are very, very positive. The first thing which central banks focus on is the inflation trajectory. The inflation trajectory in India continues to remain on the downward trend. We believe that the next 6 to 12-month inflation will be between 4.25 to 4.5%. and which is significantly positive from a bond market perspective. Secondly, I think despite INR trading at all-time lows, you are seeing a lot of positivity from an external sector perspective. Flows continue to remain good in India. This is the year where probably year to date, Jan to now, we must have got more than 1 lakh crore in debt market, FPI investments. Current account deficit remains muted thanks to commodity pressures being very, very, I think commodity prices being very weak. China continues to remain in pain. So our perspective is if I look at both inflation and external sector, which are generally the worry for central bank, they are very positive in the near term from a rate cycle perspective. And hence, with global central banks starting to ease, I think RBI will look at rate cuts in the second half of the year. We believe December onwards, every policy is live for both stance change and rate cuts. And hence, this, I think, duration cycle, once a rate cut starts, duration funds generally are a far much better advice to clients because they are good vehicles to ride the rate cut cycle, and probably they can offer you good returns from the next 6 to 12-month perspective.
Okay, so it's a good time to look at duration funds. Give us more details on this, Devang. What type of bonds are included in the fund? What is the composition?
So generally duration funds, I'm sure if you look at the issuance pattern in India, both from government side as well as on the corporate bond side, a larger part of the issuance on government bonds specifically is on the long bonds. Most of the duration funds, and we are talking about duration funds which are managing duration 7 years and above, a larger proportion of allocation would be in government bonds and some part of it would be in long corporate bonds. These are typically of the maturity of 10 to 30 year maturity bonds and generally typically holding 7 to 10 year duration. So a construct of a duration fund is largely into sovereigns and AAA corporate bonds, which are having a minimum duration of 7+.
Okay, all right. So in that case, Devang, how do these funds handle duration risk? This is one of the risks that would come by with this category, right?
Surely. So I think, see, a couple of points here to manage the duration risk. We obviously, SEBI has also allowed us using interest rate swaps to hedge our duration portfolios as well as our duration risk. But from a perspective, I think overall, these assets are very, very liquid. So once the perspective of view on the interest rate gets played out, or we start believing that the macro fundamentals are changing, all the entire portfolio is quite liquid, and we can maneuver and change the positions quite fast. We all know that government market, bond market in India is very, very liquid, and a large portfolio can be churned out. So along with mechanisms being inbuilt and allowed by SEBI, which are interest rate swaps, I think the overall, once the macro view changes, because of the liquidity, strong liquidity in such papers, the portfolio can be churned out, and we can significantly reduce the duration and reduce the volatility as well as duration risk for the investors.
Are there any other risk or cons just for an investor's understanding that they should be aware of while investing in this particular category?
So, as I told you, in bond markets, there are two categories of risk. Basically, one is the credit risk. As I explained, large part of duration funds, I would say a majority of all of them, invest in sovereigns and AAA quality papers. So we don't expect any kind of significant credit risk into the fund. The duration risk, as I told you, is highlighted through a PRC matrix, which is also a part of mutual fund fact sheets, which disclose that what duration the funds are holding. The duration mandate is specified there. So a fact sheet disclosure just offers you all the entire risk elements associated with the funds. But as explained, the portfolio is very, very liquid, and we have mechanisms to hedge our duration. So those all can be taken across while looking across at investing in duration funds.
Okay, all right. Thank you so much, Devang, for explaining this category to us. Definitely in focus after the central bank action across the globe, as you mentioned. It's just not Fed. We're seeing it overall. Thank you so much for joining in with your insights today.
Thanks, Sonu.
Okay, all right. That's all we have on the show today. But stay tuned for Closing Bell to take you through the last hour of trade.